In present video, I'm going to explain about introduction to derivatives market. Financial instruments, also known as financial assets or securities, are divided into three types: equity, debt, derivatives. Equity means stock, nothing but shares. Debt means bonds, mortgages, etc. So derivatives come under financial instruments. So derivatives are securities. Before knowing the meaning of derivatives word, let us see the evolution of derivatives.
In the world, derivatives are existed from ancient times. Farmers used to use derivative forward contracts to lock in their prices of crops before harvesting. The first commodity trading exchange, Chicago Mercantile Exchange (CME), was established on December 17, 1898. It played a significant role in developing and standardizing derivatives. The modern derivatives, futures and options in commodities were introduced in 1970s. In 1980s and 90s, financial derivatives are introduced like interest rate swaps, currency swaps, and equity derivatives. Today, because of advanced technology and electronic trading system, the efficiency, accessibility, and liquidity of derivatives are increased and derivatives trading expanded globally. Let us see the evolution in India. In June 2000, the first derivative index, futures, was introduced in Bombay Stock Exchange. In November 2001, stock futures were introduced. In June 2001, index options were introduced. In July 2001, stock options were introduced. In August 2008, currency futures and currency options were introduced. In January 2014, the Reserve Bank of India permitted the introduction of interest rates (IRF) in India. Today, National Stock Exchange, Bombay Stock Exchange are offering a wide range of derivative products including equity derivatives, commodity derivatives, and currency derivatives. NSE is the largest derivative exchange in the world. In Indian stock market turnover, more than 90% is from derivatives. You can imagine how big is the derivatives market in India. In NSE, there is called Nifty Futures. This is a derivative of Nifty. This Nifty future is the most traded derivative contract in the entire world. The Securities Exchange Board of India, SEBI, is framing rules and regulations to ensure transparency, efficiency, and investors' protection in derivatives market.
Let us see the meaning of derivative word. See, in financial markets, this is the meaning of derivatives. So to understand this sentence, first you should know the general meaning of derivative word. Suppose I have given one statement. Depreciation word is derived from a Latin word deprecium. Here I am using derived word now. What is the meaning of this sentence? English word depreciation came from a Latin word deprecium. So derived means what? Coming as a result of something. For example, curd is a derivative of milk. From milk, curd comes. Here, milk is known as underlying and the curd is known as derivative of this milk. Similarly, if you mix water in this curd, result is buttermilk. So here buttermilk is known as a derivative and buttermilk is deriving from curd. So curd is called underlying. Similarly, from buttermilk we can derive butter. So butter is a derivative of buttermilk. So if you heat crude oil in different temperatures, you will get petrol and diesel. So petrol, diesel are the derivatives of crude oil. Similarly, apple juice is the derivative of apple. Gold ornaments are the derivatives of gold. So in financial market, see the definition for derivatives. Derivative is a financial security or financial contract whose value derives from an underlying asset like a security or commodity or group of assets like an index. So to understand the meaning of this sentence, you should know the types of derivatives. Let us see the types of derivatives. Types of derivatives. There are mainly two classes of derivatives: log derivatives, option derivatives. Forward derivatives, futures derivatives, and swap derivatives. They come under log derivatives. Call option and put option come under option derivatives. Individual investors participate in future derivatives and option derivatives. Individual investor means a common man like us. So here future derivatives and option derivatives. These two are known as F&O segment. So futures and options segment. And forward derivatives, swaps derivatives. These two are traded by institutional investors. Institutional investors means firms, organizations, banks, insurance companies, mutual funds, pension funds, etc. So among these two, F&O segment is most popular because individual investors participate in this market. So finally, there are four types of derivatives: forward derivatives, future derivatives, option derivatives, swap derivatives. In my coming videos, I will explain about each derivative. So in present video, I will explain the meaning of a simple derivative, that is forwards derivative. So with the help of that, we will see the meaning of derivative word. Forward derivative agreement. ABC Limited is one crude oil producing company. On 1st January 2023, assume that market price of crude oil is 6,000 rupees per barrel. Here, 1 barrel is equal to 158.987 liters. And this company is expecting a fall in future prices of this crude oil. Means ABC Limited is behaving like a bear. Assume that after 3 months, on 1st April 2023, market price became 5,500 rupees per barrel. Then there is a loss of 500 rupees to company. No? Thus, when crude oil price fluctuates, seller is exposed to some loss. Similarly, XYZ Limited is one oil refinery company. They are manufacturing petrol. For that, they need crude oil. They are expecting that in future, this crude oil price will increase. Means they are behaving like bulls. Observe, seller is behaving like a bear. Seller is expecting that in future price will decrease. And the buyer is expecting that in future price will increase. Buyer is behaving like a bull. Means they are expecting in opposite way. Then only there is a possibility of a derivative contract. Here, assume that after 3 months, on 1st April 23, as per their expectation, market price became 6,500 rupees per barrel. So from 6,000 to 6,500, it is increased. So 500 is a loss to buyer, no? Means because of the fluctuations in crude oil, buyer is also exposed to some risk. So the seller and buyer both want to eliminate this risk. Assume that they know about each other. Then they may enter into one agreement on 1st January 2023. So what is the agreement? ABC Limited can supply 10,000 barrels of crude oil to XYZ Limited on 1st April 23. Similarly, XYZ Limited is ready to pay the money for their purchases on 1st April 2023. Therefore, the agreement is on 1st April 2023, ABC Limited has to sell 10,000 barrels of crude oil to XYZ Limited. At which price? Not at 6,500, not at 5,500, not at 6,000. So these two parties will come to one agreement. So as per that agreement, the price is 6,200 per barrel. So both parties are accepting for this amount. So if crude oil is sold and purchased at this price, there is no loss to seller, no loss to buyer. So on 1st April 2023, price may become 5,500 or 6,500. But at what price these two parties buy and sell the crude oil? At 6,200 only. Thus, these two parties can eliminate from this risk. Now, this agreement is known as forward derivative. So here, regarding this derivative agreement, there are some important terminology. You should know the meaning of these terms. First word is underlying asset. In this example, crude oil is known as underlying asset. So the most commonly used underlying assets in derivatives markets are financial instruments, means stocks, bonds, commodities, for example, agriculture products, rice, wheat, cotton, otherwise crude oil, precious metals, gold, silver, etc. Next, currencies, interest rates, market indices, for example, Sensex, index of BSE, otherwise Nifty, index of NSE, properties such as land, building. So the features of all these underlying assets are, first one, they are easily marketable, so we can easily purchase and sell them. Second one, their market values fluctuate. Second word is lot size. Assume that XYZ Limited has not entered into this contract. Then they can buy this crude oil in any quantity, 1 barrel, 10 barrels, 100 barrels, according to their requirement. ABC Limited also same. So they can sell this crude oil in any quantity. But as they have entered into this derivative contract, on 1st April 2023, ABC Limited has to sell 10,000 barrels compulsory, and XYZ Limited should buy 10,000 barrels compulsory. Here, this 10,000 barrels is known as lot size or contract size. Third one is spot price. They are entering into an agreement on 1st January 2023. Now, on that day, current price of crude oil is 6,000 rupees per barrel. So this price is known as spot price. Fourth word is strike price. On 1st January 2023, when they are entering into this agreement, they have decided to supply the goods in future at 6,200 rupees. No? This 6,200 rupees is known as strike price. Means strike price will be decided at the time of entering into the contract. Fifth word is expiry date. See this example. ABC Limited has to supply the oil to XYZ on 1st April 2023. No? So contract date is 1st April 2023. That contract date, settlement date is known as expiry date. After this date, this agreement becomes void. Suppose ABC Limited is going to supply the goods after this date, say on 5th April 23. In this case, XYZ Limited need not to obey to this agreement. Means they need not to buy the crude oil. So they can refuse. The next word is delivery date. So in this example, ABC Limited has to deliver crude oil to XYZ Limited on 1st April 23. No? So 1st April 23 is known as delivery date. Means here expiry date and delivery date both are same. Sometimes these two dates may differ. For example, ABC Limited is going to settle the transaction on 1st April 23 only, but they need more 2 days to deliver the crude oil to XYZ Limited. They took permission from them. Here, expiry date is 1st April 23, but delivery date is 3rd April 23. Suppose ABC Limited is able to deliver the crude oil before this date. Say they need the oil before this expiry date on 25th March 2023. And at that time, this company is ready to deliver the goods. Here, delivery date is 25th March 23, but expiry date is 1st April 23. Thus, expiry date and delivery date both may be same or they may differ. So in this example, ABC Limited is expecting a fall in future prices now, and XYZ Limited is expecting a rise in future prices. On 1st April 2023, two possibilities are there. First one, price may decrease as per the expectations of ABC Limited. Second one, price may increase as per the expectations of XYZ Limited. Suppose on 1st April 23, market price of crude oil is decreased to 5,500 rupees. Then think from ABC's limited point of view. In outside market, now the price is 5,500 per barrel. But as per agreement, they are selling at a 6,200 rupees per barrel to XYZ Limited. Thus, profit for them is 6,200 minus 5,500, 700 rupees per barrel. Think from XYZ's point of view. They have expected a rise, but price is decreased. So their expectations went wrong. Then in outside market on 1st April 23, crude oil is available at 5,500 rupees per barrel. But as per the contract, they have to buy this from ABC by paying 6,200 rupees per barrel. So how much extra they are paying? 6,200 minus 5,500, 700. This 700 is lost to XYZ Limited. Now see the another scenario. On 1st April 23, say market price became 6,500. Means XYZ's expectations came true. Then ABC Limited analyze from their point of view. In outside market, one barrel price is 6,500 rupees. But as per the contract, they have to sell to XYZ Limited for 6,200. So instead of selling at 6,500 to outside parties, they have to sell to XYZ Limited at 6,200. So they are losing 300 rupees now. This is loss to them. Now think from XYZ Limited point of view. In outside market, crude oil is available at 6,500 rupees per barrel. But as per the contract, they can buy them from ABC Limited by paying only 6,200 rupees per barrel. So finally, there is a profit of 300 rupees per barrel. Thus, in derivative contracts, if one party loses, other party gains. Because one party is expecting that future prices will decrease, another party is expecting that future prices will increase. Obviously, both cannot be true now. So if one expectation becomes true, another's expectation should get false. That is why when one party is gaining, other party loses. Now let us see the meaning of forward derivatives contract. Forward derivatives are financial agreements between two parties, buyer and seller, to buy or sell a fixed quantity of an underlying asset at a predetermined price and delivery date in the future. Underlying asset, in this example, crude oil. So this underlying asset value is fluctuating. Sometimes market value is decreasing, sometimes market value is increasing. If market value decreases, it is a loss to seller. If market value increases, it is a loss to buyer. Means seller and buyer both are exposed to price fluctuations risk. So to eliminate this risk, these two parties are entering into one agreement. So this is one agreement now. As per this agreement, ABC Limited has to deliver 10,000 barrels of crude oil to XYZ Limited on 1st April 23 at the rate of 6,200 rupees per barrel. Here, forward derivatives are financial agreements between two parties, buyer and seller. Buyer is so XYZ Limited. Seller is ABC Limited. For what? To buy or sell. So XYZ Limited is accepting to buy. ABC Limited is accepting to sell a fixed quantity of an underlying asset. See, underlying asset is crude oil, and as per agreement, a fixed quantity 10,000 barrels of crude oil is to be purchased and sold now at a predetermined price. So price is not the current price, 6,000 rupees. On 1st January 2023, these two parties have agreed to transact at 6,200 rupees. So this is known as a predetermined price and not immediately. So here contract is made on 1st January 23, but they are not going to buy and sell on that day. Delivery date in the future. So on 1st January, they are going to make an agreement where they have to sell and buy on 1st April 23. So in spot trading, suppose you are buying shares, debentures. Here investor is paying money and buying the securities at present. But here at present we are making a contract to transact in future. So that is the feature of derivative contract. So with this sentence, with the meaning of forward derivative contract, now let us see the meaning of derivatives market. Derivative is a financial security or financial contract whose value derives from an underlying asset like a security or commodity or group of assets like an index. What is the meaning of this sentence? Observe here. This is one derivative agreement. No? This agreement value is 6,200 rupees. How this value came? Based on the value of underlying asset, crude oil. So crude oil present price is 6,000 rupees. So in future this price may decrease or increase. So by keeping these prices in mind, these two parties made one agreement to buy and sell in future at a 6,200 rupees. So derivative price is deriving from the fluctuations in the market prices of underlying assets. So derivative has no value. Its value derives from underlying asset market value fluctuations. For example, petrol and diesel. These are the derivatives of crude oil now. So petrol has no value of its own. Petrol's value depends on crude oil's value. Similarly, apple juice value derives from apple value. Gold ornaments value derives from gold value. Thus, some underlying assets will be there. These underlying assets market value is fluctuating. If market value fluctuates, sometimes to seller, sometimes to buyer, there will be some loss. So to eliminate this risk, if a seller and buyer enters into an agreement, then that agreement is known as a derivative contract. So here the quantity, price and the delivery dates are prefixed. The advantage of derivative contract is market price may be anything, but these two parties can maintain a fixed price for a long period. So 1 barrel crude oil will be 6,200 rupees only. So derivatives are useful to maintain price consistency. For example, take potatoes. Potatoes market value fluctuates, but chips packet value is not fluctuating now because of this reason. Similarly, crude oil price may fluctuate, but petrol price is not fluctuating now. So for a long period it remains fixed because of derivative agreements. Next topic is who participates in derivatives market. In this example, seller ABC Limited and buyer XYZ Limited are participating in this derivative agreement. Now the question is who acts as a seller and buyer in derivative contract. When a person is entering into a derivative contract, so he is entering to attain a particular objective, no? With a particular aim only he is entering into the contract. Based on that aim, based on that objective, the participants in derivative markets are divided into three types: hedgers, speculators, and arbitrageurs. Let us know about them one by one. First one, hedgers, means persons who do hedging activity are known as hedgers. Hedging is a strategy used to mitigate the future risk in the financial assets. Here, crude oil is one financial asset, no? It is a commodity, no? So commodities, currencies, interest rates, stocks, bonds, all these are financial assets. So these are financial assets value is fluctuating in future. So when it fluctuates, sometimes to seller there is a loss, sometimes to buyer loss will come. So there is a risk of getting losses. So to mitigate, to eliminate these risks, if these two parties enter into one agreement, so here entering into a derivative agreement is a strategy, a plan to minimize this risk. Now that planning is called hedging. So here seller is having a risk. In future, if crude oil price decreases, seller gets a loss. He wants to eliminate this risk. Similarly, buyer is also facing one risk. In future, if crude oil price increases, to buyer there will be a loss. So to eliminate this risk, these two members are entering into a derivative contract. So here ABC Limited and XYZ Limited are known as hedgers. And by entering into a derivative contract, they are doing hedging activity here. They are eliminating the risk here. Who participate in derivatives market? Under that second point is speculators. So a person who does speculation is known as speculator. Speculation means earning profits from the price fluctuations of underlying asset. Till now, to explain the points, I have taken the help of forward contract now. But speculation business, generally we can see in futures and options. So there are four types of derivatives: forwards, futures, options, and swaps. In futures and options, we can see speculators. Therefore, to explain this point, I will take the help of future derivative. In my coming videos, I will explain clearly about this future derivative. Now, only meaning I will explain to you. See, forward derivative, future derivative, both are almost same. Only the difference is, in case of forward derivative, seller of underlying asset directly deals with buyer of underlying asset. Means between them there is no mediator. But here in future derivative, seller and buyer of underlying assets deal with each other through a broker, a mediator. So stock exchanges and commodity exchanges, they act as mediators here. Forward contracts are customized contracts. Future contracts are standardized contracts. So in forward contract, seller and buyer, they decide the lot size, underlying asset, strike price, and expiry date. But in future contract, all these points are decided by the exchange. So with one example, we will see what is future derivative contract. On 1st January 2023, one public limited company, XYZ Limited, its one share market price is 100 rupees. And on the same day, exchange has given a quotation where the underlying asset is XYZ Limited share, and the future derivative quotation is 1000 shares of XYZ Limited should be delivered by the seller to the buyer on 1st April 23 at the rate of 120 rupees per share. And these shares are possessed by Ravi. So Ravi is possessing XYZ Limited shares. On 1st January 2023, Ravi is estimating that in future price may decrease. So today's price is 100 rupees now, spot price is 100. He is expecting that in future price may decrease. Means Ravi is acting as a bear. As per his expectation, suppose on 1st April 23, price is decreased to 80 rupees. Then how much is the loss to Ravi? 20 rupees now, 100 minus 80. So he wants to eliminate this risk. Similarly, Gopi is one investor. He wants to purchase XYZ Limited share. So on 1st January 23, one share is available at 100 rupees in the market now. But the problem is he cannot pay that amount on 1st January 23. He wants some time to purchase these shares. And his fear is in future share price may increase. So in future only he wants to buy, but not at increased prices. Suppose on 1st April 23, as per his expectation, really price increased to 150 rupees. Now the problem is at 150 per share he has to buy now. So there is a loss of 50 rupees to him. That is his problem. He wants to eliminate this risk. Gopi is estimating that in future share price will increase. Means Gopi is acting as a bull. To eliminate this risk, these two parties entered into forward contract which is quoted by this exchange. So on 1st January 23, Ravi purchased this forward contract from exchange. So as per this contract, on 1st April 23, Ravi sold 1000 shares of XYZ Limited shares at the rate of 120 rupees each. Similarly, on 1st January 23, Gopi also purchased this contract from exchange. As per this contract, on 1st April 23, Gopi has to purchase 1000 shares at the rate of 120 rupees per share. So here, while buying this derivative, Ravi doesn't know about Gopi and Gopi doesn't know about Ravi because they are dealing through a mediator now. Now, assume that in future, say on 1st April 23, as per Ravi's expectation, really share price decreased. So price decreased to 80 rupees. Even though in outside market price is 80, Ravi can sell these shares to Gopi at 120 rupees now. Because strike price is 120 rupees, agreement price is 120 rupees. Then profit to Ravi is at 120 he is selling, but in outside market on that day price is 80 rupees. So on share he is getting a profit of 40 rupees. And he is selling 1000 shares now. Therefore, his total profit is 1000 shares into 40 rupees each, 40,000 rupees. And same amount is a loss to Gopi. So in outside market, share is available at 80 rupees. But as Gopi entered into this future derivative contract, he has to buy that share by paying 120 rupees each. How much extra he is paying? 40 rupees on share. This is loss to him. So total loss is 1000 shares he is buying. On one share, 40 rupees the loss, means 40,000 is the loss to Gopi. So here, seller's expectation became true and the buyer's expectation went wrong. Take another scenario. On 1st April 23, assume market price is increased to 150 rupees. So buyer is expecting that market price will increase in future now. His expectation came true. In this case, in outside market, on 1st April 23, one share market value is 150 rupees. But Ravi has to sell these shares to Gopi for 120 rupees each. So he is getting 30 rupees loss per share. Total loss is he is selling 1000 shares now. 1000 shares into 30 rupees each, 30,000 rupees. And think from Gopi's point of view. In outside market, on 1st April 23, one share price is 150 rupees. But as per this agreement, he can buy them at 120 rupees only. So he is paying 30 rupees less. This 30 is profit to him. So total profit is On 1000 shares at the rate of 30 rupees each, 30,000 is the profit to Gopi. Thus, there is no much difference between forward derivative and future derivative. So now you got some idea about future derivative agreement now. Now with this information, let us see how people do speculation by using future derivative agreements. In first example, really Ravi is having XYZ limited shares. He can deliver these shares on 1st April 23 to Gopi. Similarly, really Gopi wants to buy XYZ limited shares. He wants to possess them. He wants to take regular dividends from that company. So on 1st April 23, really he takes the shares delivery. So here Ravi and Gopi come under hedgers. Not only hedgers, derivatives can be traded by speculators also. Assume that Mohan and Kiran both are speculators. Mohan on 1st January 23, he is expecting that XYZ limited share price will decrease in future. On 1st January 23, price is 100 rupees now. Mohan is predicting that in future price will decrease. Means he is acting as a bear speculator and he wants to make some profit from these price differences. Here Mohan is not possessing these shares even though he wants to earn profit by using these shares. On 1st January 23, Mohan purchased this future derivative from exchange. On the other hand, Kiran is also a speculator and on 1st January 23, Kiran is predicting that in future XYZ limited share price will increase and from these price differences he wants to make some profit. Then what he did? On 1st January 23, he went to exchange and he purchased this future derivative. Now, as per these derivative agreements, terms and conditions, on 1st April 2023, Mohan has to deliver the shares now, but he is not the owner of the shares. He is the owner of only future derivative agreement. Similarly, on 1st April 23, Kiran has to really take the delivery of these shares by purchasing them, but he is not interested in that. So they behave only as a speculators and how they earn profit, observe. Suppose on 1st April 23, really share price is decreased. Share price became 80 rupees. Now what Mohan does, in outside market, one share price is 80 rupees now. So at the rate of 80 rupees, he purchases these shares from somebody. And with these shares, he fulfills this contract. As per this contract, he has to sell 1000 shares to Kiran at the rate of 120 rupees each now. He fulfills that contract. So here, from outside market, he is buying one share at 80 rupees and to Kiran, he is selling one share at 120 rupees. So profit to him is 40 rupees per share. And share price decreased means Mohan's expectations came true and Kiran's expectations went wrong. For Kiran, this 40 rupees loss because in outside market, one share price is 80 rupees. He can buy from outside people at 80 rupees each. But at what price he has to buy from Mohan? For 120 rupees. So on each share, he is paying 40 rupees extra. That is loss to Kiran. Assume that on 1st April 2023, instead of decreasing, share price is increased. So Kiran's expectations came true. Then in outside market, on that day, one share price is how much? 150 rupees. But Kiran can buy these shares from Mohan at 120 rupees only. So at 120 rupees, he purchases these shares from Mohan and in outside market, he sells them at 150. So per one share, his profit is 30 rupees. And here, same amount is a loss to Mohan. Because in outside market, price is 150. Mohan can sell the shares to outside people at 150. But as he entered into this future derivative contract, he has to sell to Kiran at the rate of 120 rupees each. 30 rupees lost to Mohan. So in derivative speculation, two terms are very important: short position, long position. Let us see about these two words. First word is short position. A situation where one party sells a derivative contract without owing the underlying asset with the intention of buying it back in future at a lower price. Mohan did exactly the same. So in this example, Mohan is taking a short position. Observe, short position is a situation where one party, nothing but Mohan, sells a derivative contract. So Mohan is selling a derivative contract, nothing but XYZ company shares on 1st April 23 no? Contract without owing the underlying asset. So Mohan is not having these shares, but he is ready to sell them with the intention of buying it back in future at a lower price. So he is accepting to sell these shares on 1st April because his intention is in future share price will decrease. Then from somebody I will buy these shares at a lower price, 80 rupees, and with these shares I will fulfill this commitment. Come to long position, second word. A situation where one party buys a derivative contract with an intention that the value of the underlying asset will increase in future. They sell it to others for a higher price in future. See, Kiran did exactly the same. Long position is a situation where one party buys a derivative contract. Kiran is buying this derivative contract with an intention that the value of the underlying asset will increase in the future. So Kiran is expecting that in future price increases. He wants to make profit from this increase. That is why he is buying this derivative contract. Continuation. They sell it to others for a higher price in future. So he is buying these shares at the rate of contract price, 120 rupees. But like a common investor, they don't keep the shares with them. So when market price increases in outside market, they sell for these higher prices and they make some profit. So Kiran is taking long position here. So this is all about second type of participants, speculators. Now the third participants are arbitrators. Arbitrators. Suppose XYZ Companies Limited share is trading in two markets, in Bombay Stock Exchange at 100 rupees each and in future market at 105 rupees each. So there is a difference in this price quotations. No? Now arbitrator is a person who tries to earn some profit through these price differences. So if he wants to earn some profit from BSE, he has to purchase these shares at 100 rupees and in future market he has to sell them at 105 rupees. Then on one share he gets a profit of 5 rupees. Here arbitrator is not taking any risk. Hedgers, speculators, arbitrators. Observe the difference between these three. Hedgers avoid risk by incurring some cost. So in our example, so ABC Limited and XYZ Limited, these two companies are avoiding their risk by entering into a forward derivative contract. No? So they are known as hedgers, and to avoid this risk while entering into this derivative contract, sometimes they spend some expenditure also. In coming videos, I will explain about this cost point. Next, come to speculators. Speculation is a risky activity. So what they do? Speculators make profits by taking risk. Hedgers are transferring their risk to other parties. But speculators, by purchasing derivatives, they are entering into risk. Okay, they take risk to earn some profit. And arbitragers, they also make profits, but without taking risk. Next topic is how to trade derivatives. See, Kumar wants to purchase vegetables. He has two options. First option is he can buy the vegetables directly from farmer. This is known as trading over the counter, OTC. Here, between the buyer and seller, there is no mediator. Advantage is he can bargain. Disadvantage, he cannot have more varieties of vegetables. In derivatives market, forwards and swaps, these two derivatives are traded under OTC method. Kumar has another option. That is, instead of directly buying from farmer, he can purchase these vegetables from supermarket. So supermarket purchases the vegetables from different farmers. So advantage is he can have more variety of vegetables. Disadvantage, he cannot bargain. He has to buy at fixed prices. In derivatives market, futures and options are traded under this method. Here, between the buyer and sellers, there is one mediator. No? In derivatives market, that mediator is known as exchange. For example, National Stock Exchange, Bombay Stock Exchange, Multi Commodity Exchange. So they act as mediators. Next topic is how settlement is done in derivatives market. There are two settlement systems. First one, physical delivery system. Recollect forward derivatives example. On the expiry date, on the delivery date, 1st April 2023, ABC Limited is delivering 10,000 barrels of crude oil to XYZ Limited now. So there is a physical movement of underlying asset from seller to buyer. That is known as physical delivery settlement system. Next one, cash settlement system. Here, seller physically doesn't give the underlying asset to buyer. So they deal with only cash differences. In coming videos, I will explain about this. Then, next point is derivatives are off-balance sheet instruments. See, derivatives are also securities, no? Financial assets, no? Like stocks, bonds, debentures. So stocks, shares, debentures, we show in balance sheet. They are balance sheet items. But derivatives are not shown in the balance sheet. So they are shown below the balance sheet under footnotes. Then last point is derivatives are related to secondary market. In financial market lesson, you learn one point. Financial market is divided into two types, no? Capital market and money market. Capital market is again divided into primary market and secondary market. Secondary market is also known as stock exchange. In primary market, what happens? Companies, for their capital requirements, they sell securities to the investors. For example, shares, bonds, etc. At face value, company sells to investors. In secondary market, the investor who purchased the securities in primary market, he sells these securities to another investor at market price at higher values and he makes some profits. Now, derivatives are also securities, no? But these securities are not traded in the primary market. Means company doesn't issue derivatives for their capital requirements. So in primary market, company is issuing stocks, no? Based on the fluctuations in these stocks market prices. In secondary market, derivatives are created and traded between the parties. So this is the end of present video. Hope this video is helpful to you. Thank you.